ladies and gentlemen, esteemed colleagues and distinguished guests, it is an honor to be able to discuss with you today the critical topic on rechanneling SDRs. I request 15 minutes of your time to delve into three main areas that are significant towards Africa's potential and capacity to access the necessary finance to catalyze its economy, expand its market, meet its development goals, secure its fiscal space, and alleviate the burdensome constraints that debt service imposes on these countries. So what you see on the slide are the three areas that I will be discussing with you today. Now, I will begin by exploring the limitations of the IMF rechanneling mechanism and why alternative routes through either multilateral development banks or UNECA's Liquidity and Sustainability Facility offer promising opportunities for African countries to obtain what we want is unfettered financial resources. Now, SDRs, like John began the webinar explaining, are simply a supplementary foreign exchange reserve asset. They are created by the IMF to supplement member countries' official reserves. They are allocated to member countries in proportion to their IMF quotas, which are based on their relative size in the global economy. Now, African countries also participate in the creation of SDRs by contributing to the IMF through their quotas. The size of each country's quota is determined based on its economic size and its financial contributions to the IMF. We've also had African countries make significant contributions towards SDR, and the statistics are right here on the screen for you. Now, in addition to contributing to SDRs through the IMF quotas, African countries, they use SDRs to finance trade and other economic activities, to purchase the freely usable currencies of other IMF members, which can help to promote economic development and stability of African countries or in African countries by providing a supplementary source of international reserve assets. This actually helps to reduce the reliance on individual currencies and reduces the risk of exchange rate fluctuations. Now, SDRs are commonly rechanneled through IMF's designation mechanisms, for example, through its liquidity support facility. This is also a financial mechanism which is established by the IMF that allows countries facing temporary balance of payment difficulties to borrow from the fund to finance their external payment needs and stabilize their economies. Now, to borrow from the IMF, a member country must first request financial assistance from the IMF and then demonstrate that it is facing a temporary balance of payments difficulty. The IMF will then assess the country's request, and if it is approved, the country will then be able to borrow from the IMF in the form of SDRs. The country will then be required to repay the SDRs to the IMF at a later date with interest. So, rechanneling SDRs to Africa through the IMF is also useful for a number of reasons, right? First is that it can help African countries facing temporary balance of payment difficulties to stabilize their economies and avoid a financial crisis. It can also help African countries to maintain economic and financial stability by providing a source of financing that is not subject to the market risk and volatility associated with borrowing from private sources. It can also help African countries preserve their policy flexibility by providing financing that is not subject to the conditions that are often attached to loans from private sources or other international financial institutions. But SDRs must be used for international transactions and cannot be used to finance domestic budget deficits or to purchase domestic assets. So what we're seeing is that there are limitations when it comes to rechanneling SDRs through the IMF. And the other limitations, including the inequality John talked about, is that this quota-based allocation system, it basically results in larger and wealthier countries, basically the European nations, receiving a larger share of SDRs, while smaller and poorer countries receive a smaller share. This definitely exacerbates existing inequalities and limits the resources available to countries that need them the most. There's also the fact that while SDRs can provide short-term liquidity support, they do not address the long-term development needs and structural issues that are faced by African countries. That's why we really need to focus on why do we need to rechannel SDRs away from the IMF and rather into the MDBs or through UNECA. So the options are basically two. We may say there are three options if you add reforming the IMF's approach, but today our focus is only on two options, and we want to start with the multilateral development banks. Now, rechanneling SDRs through MDBs can actually be beneficial for African countries for several reasons, right? MDBs provide loans and financial assistance for economic development, infrastructure projects, and environmental protection, much more than what the IMF would be able to do through its LSF mechanism in itself. Rechanneling SDRs through MDBs could help African countries access additional financing for such projects, supporting economic growth and improving their living standards. MDBs also offer technical assistance, such as capacity building and policy reform support to their member countries. So accessing SDRs through MDBs can grant African countries this specific assistance. It can strengthen local institutions and also enhance development project impacts. We're also saying that rechanneling SDRs through MDBs, it's because MDBs possess sector-specific expertise, right? When you rechannel SDRs through MDBs that have this sector-specific relevant expertise, they can provide African countries with specialized knowledge and technical assistance to improve project design and implementation. This would lead to greater fiscal capacity and strengthening of fiscal capacity in the long term to come. But rechanneling SDRs through MDBs could also potentially benefit African countries in various development areas more than what the IMF would be able to do. For example, in infrastructure development, in agricultural development, as well as environmental protection. So addressing environmental challenges such as climate change and deforestation is very crucial currently for African countries, much so where there's food insecurity being prevalent. Now, when we rechannel SDRs through MDBs like the Global Environment Facility, the GEF, this can finance projects to protect natural resources, promote sustainable land use, and reduce emissions. And we're already seeing that there's certain instances where SDRs have actually been rechanneled through GEF. This is only because the IMF mandate is kind of restricted. But when you rechannel SDRs through mechanisms outside the IMF, then countries are able to benefit much more better. So rechanneling SDRs through MDBs can potentially provide African countries with the increased financing that is much desirable at this moment. With technical assistance and specialized expertise, it can support economic development and improve living standards in the region. But ladies and gentlemen, there is also the Liquidity and Sustainability Facility that has been established by the United Nations Economic Commission for Africa. Now, the UNECA's LSF is a financial mechanism, and it is aimed at helping African countries access affordable financing and reduce liquidity premiums that are associated with international bond markets. It establishes a repo market for African sovereign bonds, increasing liquidity and attractiveness to foreign or international investors. Now, this could lead to improved financing access and reduced borrowing costs for African countries. So just to quickly explain what a repo is, it's a sort of a repurchase agreement. It's a short-term collateralized loan between two parties, typically involving the sale and future repurchase of securities like government bonds. It's got nothing to do with SDRs. This financial instrument is crucial for managing liquidity among financial institutions and maintaining stability within the financial system. Repos also enable institutions to borrow or lend money quickly, often at lower costs compared to unsecured loans. So when we look at the LSF, there are a number of advantages, right, or a number of strengths to be able to use this mechanism for purposes of rechanneling the SDR. And some of these advantages are that by creating a repo market, the facility may increase liquidity and attractiveness of African sovereign bonds, leading to improved financing access, which would mean it would be a a well-grounded, a strong, efficient, feasible mechanism to be able to route SDRs through it as well. The facility could also reduce liquidity premiums, lowering borrowing costs and leading to long-term savings. And it establishes a market on par with international standards, which could increase the credibility and attractiveness of African sovereign bonds, enhancing financing access. So SDRs could actually be used in this particular instance to be able to work within African sovereign bonds as well. However, there is a lack of data to assess whether UNECA's LSF is a preferable option compared to MDBs. So furthermore, there are some challenges and limitations of the UNECA LSF itself, which include issues like the countries with weak credit ratings may still face difficulties accessing international bond markets. There is the dependence on external funding, right? So reliance on external funding itself by the LSF or UNECA could limit the facility's flexibility and sustainability. The facility might also be subject to political influence from member countries, which may impact its effectiveness and independence. So overall, while the UNECA LSF has potential benefits, there is insufficient data to determine its effectiveness and sustainability compared to MDBs. It remains uncertain whether the facility provides financing not subject to market risks and volatility associated with private borrowing sources, making it an unpredictable financing option. So what we're seeing is that MDBs itself appear to be a more suitable option for rechanneling SDRs to African countries if we're to compare it with UNECA's LSF, due to MDB's broader scope of support, extensive experience, and ability to leverage additional resources. MDBs have a strong track record in development finance and offer a wide range of services beyond financing itself. They have established relationships with governments and partnerships with other development actors, allowing them to better address African countries' development needs. And additionally, MDBs can provide long-term financing and they have stronger governance structures. On the other hand, UNECA's LSF could help lower borrowing costs and reduce debt for member countries in certain situations, but it is not a substitute for comprehensive long-term solutions to economic challenges. MDBs are more attuned to recipient countries' specific needs and priorities and can offer flexible, customized financing solutions. So while both MDBs and UNECA can play important roles in supporting economic growth and development in Africa, MDBs appear to be the more effective choice for rechanneling SDRs. However, there are challenges that are faced by MDBs in itself, which would require political intervention for resolution. And I say this with the Africa Development Bank in mind as the intermediary through which to rechannel SDRs. So first of all, rechanneling SDRs through the AFDB offers several advantages for African countries, right? The AFDB has a unique understanding of the development needs and priorities of African countries, ensuring that rechanneled SDRs are used effectively. The bank also has robust governance structures, which would ensure transparency, efficiency, and accountability in the use of SDRs. The bank can also align the use of rechanneled SDRs with its existing programs and strategies to maximize impact. But there is a need to strengthen the AFDB in the first instance, right? And there's several policy steps that could be taken. The most important ones are for the members of parliament present today and other policy makers, is that number one, we need to be able to encourage African governments to participate in the bank's capital increase initiative, which aims to increase the bank's capital base and provide more financing for development projects. We also need to increase African governments' participation in the bank's African Financial Markets Initiative to develop and deepen financial markets in Africa, focusing on local currency bond markets. And then we also need to support the bank through increased participation in the bank's various loan and grant programs, which will help finance development projects and increase the demand for SDRs in Africa. So by leveraging its experience, relationships, and governance structures, the Africa Development Bank could play a significant role in rechanneling SDRs to African countries, promoting economic development and stability in the region. But in addition to just the SDRs, right? While definitely rechanneling SDRs can provide crucial financial support to African countries, it is essential to explore alternative mechanisms as well to address the continent's fiscal challenges. And I'll just take 2 more minutes before I conclude and speak about just 3 main alternative financing mechanisms that we should also start reflecting about. And the first one is the local currency bond markets. Developing local currency bond markets can help African countries reduce their reliance on foreign currency borrowing and support domestic financial market development. And we're seeing this happening with BRICS already. Kenya is also beginning to follow this approach by saying that they want to start trading in the shillings and, they want to leave the dollar behind. This can lead to increased economic resilience as countries are less exposed to fluctuations in the foreign exchange rate and external economic shocks. Additionally, local currency bond markets can also provide a stable source of funding for long-term public investment projects, which can help foster sustainable economic growth. We don't have crowdfunding, right? And this has been underplayed for so long. Crowdfunding platforms can actually help mobilize capital for African countries to direct to SMEs, to infrastructure projects and social initiatives. These are essential for economic growth and social development. And crowdfunding kind of helps us bypass traditional financing barriers. And through crowdfunding, we can increase access to finance for underserved segments of the populations and also stimulate innovation. And then, of course, there are the grants. Rather than relying on borrowing, looking for SDRs, let's focus on getting grants from international donors and philanthropic organizations to support development projects without adding to the debt burden of African countries. This in itself can help promote long-term financial sustainability while addressing the pressing development concerns that we are dealing with. Now, finally, ladies and gentlemen, rechanneling SDRs through MDBs, specifically the African Development Bank, which is the proposal that I am making, offers a promising avenue for addressing the development needs of African countries. However, it is crucial to recognize that SDRs alone cannot solve the fiscal challenges faced by the continent. We need a comprehensive approach to development finance, which encompasses a range of alternative financing mechanisms which are necessary to promote sustainable, inclusive, resilient growth on the continent. So we should all call for a concerted effort from African governments, from MDBs, from UNECA itself, and other stakeholders to explore innovative financing solutions that would ensure the rechanneling of SDRs and other resources, that they are used effectively and efficiently to address the development challenges facing the continent.
As indicated, I'm Hobson Chavura with the Macroeconomics and Governance Division of ECA, the institution behind the thinking, the conceptualization, and the implementation of the LSF. Let me welcome all honorables here, and thank you very much for providing us the opportunity to talk about the LSF. And it is an honor for us to be part of this process. Thank you, Laila, for the thorough presentation, as well as the reflections on the LSF. Let me indicate that, unfortunately, I haven't had a chance to look at your full paper so that I could have provided some concrete suggestions and observations as required when it comes to any review of this sort. Thank you for the review on the LSF once again. The LSF was established basically to help African countries as they get out of the different crises that have been affecting the continent, as well as the whole world. And this was launched during the COP26 in 2021 in November in Glasgow. and mainly in response to the ongoing effects of the pandemic and the high costs of borrowing being affected by most of the African countries, and the issue of climate change that we need to take care of as African countries. And in the COP 2027, let me say that that's where the first transaction was carried out under the auspices of Afrexim Bank with the Euro bonds from countries such as Angola, Kenya, and Egypt. This was a historical moment with regards to the implementation of the RSF. I didn't ask Laila in the program. It seems I have about 5 minutes. Does that stand, or I forgot to ask about that? I might be talking about this for ages while I have very few minutes. Could you remind me, please?
Yeah, well, the program does say 5 minutes, but I suppose because you're making an essential contribution on LSF and to help us understand its effectiveness, I will oblige myself to allow you more time.
Okay. These challenges and these transactions actually were a landmark during COP27 in Sharm el Sheikh because they provided a ground-breaking event that the as the RSF implementation has been concerned of. Having said that, mainly the RSF, I could say, as Lyra indicated, it has two main objectives. Firstly is to support the liquidity of African countries through their sovereign Euro bonds that they issue, and also to incentivize green and SDG related investments, mostly with regards to the issue of climate change that is affecting African countries. And the studies have shown that the implementation of the RSF could actually warrant African countries to save about 11 billion US dollars over a period of the coming 5 years, making it more effective and alleviating African countries from debt vulnerability issues. And in terms of climate change, it is regarded to be a tool that will provide favorable repo terms for especially green and SDG-linked bonds that are being mostly championed by the UN. And you would agree with me that SDGs, as well as the green revolution, are some of the key issues that most African countries and their policies are targeting in order to get out of these challenges that are being faced by most of these African countries. Let me say that this LSF was actually endorsed by 26 African countries during the COP27 to initiate its implementation, and showed interest in support of this particular initiative. I will jump just to indicate how African countries could be part of this particular process. There are actually eligibility issues that African countries would need to know with regards to benefiting as well as utilizing this particular tool in financing their development objectives. Countries that are expected to use the RSF are expected to have access to the capital markets first. And as of December 2021, we had about 22 African countries that are basically accessing the capital markets, and we hope that that number will increase, maybe has already increased by now. And also it will require countries with sound economic fundamentals, as well as a good track record of policy reforms, and as well as also strong governance and the green and SDG linked bonds or issues that these countries are looking at. So you specifically note that apart from having access to the capital markets, it also looks at the economic fundamentals, how strong our economic fundamentals are, as well as what policies we have in place in relation to the green economy and the SDG linked income sources of finances. In terms of reacting to some of the questions or issues that Laira, you raised in your presentation, I will touch mostly, let me say, on two. First is the issue of data that you touched on. This basically, as you might be aware, that it's about a few months since the first transaction through RSF was implemented. During its implementation, it has not taken that long to have such kind of data to carry out those particular comparative statistics that you might be looking for. And secondly is the issue of the use of SDRs. As you might be aware, as the repo market, the RSF is expected to utilize part of the 650 billion US dollars that has been issued to countries as SDRs as part of the financing for the implementation of the RSF, and the discussions and the some negotiations are taking place to make sure these SDRs are used in that particular regard.
So as we are aware, during COVID, most of the LDCs in the least developed countries, the COVID-19 generated severe health and economic and debt crisis. And African governments were faced with extreme fiscal pressures before the pandemic. And then we look at the combined effect of the pandemic and the lockdowns. This pushed most of the governments across the continent to choose between either servicing the outstanding sovereign debt or providing some of the other measures in terms of the needed measures for health and social services for the population. And most of the global north countries, they were able to pump trillions of dollars into the economies to weather these particular shocks. And Africa did not have an option. So instead, the African governments, they were forced to borrow even more to finance their necessary emergency measures. And this has brought in the issue of sovereign debt crisis that was already at the tip point at the start of 2020. And so the issue of SDR come in handy, and it's very critical because these SDRs, the allocation, as you mentioned earlier on, the allocations are based on the quota systems, and which again, this depends on the level of economy of the different countries. And low-income countries, especially in the global south, they're hugely disenfranchised. And so ways in which the allocations that were given to more developed economies into rechanneling some of these becomes critical. So among the alternatives or mechanisms for channeling this would be the Multilateral Development Banks and even the new facility developed by the UNECA, that is the LSF. But when you come to the MDBs, the multi-development banks, they're very important because they're considered to be natural candidates for recycling SDRs, because they can be able to support development and supply global public goods in line with the Sustainable Development Goals. And the MDGs are also important because the MDBs are also important because they're able to provide financing that is affordable at or have some concessional rates. And the SDRs can only be held by prescribed holders. But for other institutions to have this privilege, either they would need to be prescribed by the IMF or the IMF would need to change their rules. But then we find that some of the MDBs are already prescribed holders of SDRs, and they can be able to facilitate recycling of these SDRs through these particular institutions. I guess an example, I just went through the concept that you shared. There was a mention of the Afrexim Bank. And in this case of this bank, the mission is to provide trade finance where SDR allocations are intended in first instance to respond to social issues in the medium term to support African economies to be more resilient. But then to be included in the list of the regional institutions through the SDRs, this Pan-African bank, it needs to demonstrate how it can be able to operate to make progress to this goal. Another good example would be the AFC, the African Finance Corporation, which is a major private sector owned, and it faces some political issues as well as practical issues in terms of how it can be able to assist in this particular issue. So there's no imperative to provide concessional financing to AFC instead of other private sectors that operate in Africa. But then on the other hand, there's the FDB, the African Development Bank, and the IDB that you also mentioned in the report, that is the Inter-American Development Bank. They have good AA ratings, and they have a strong standing in the capital markets. They're able to absorb risk in terms of their balance sheets and offer member countries affordable financing terms. And regional banks could use the IMF reserve to lend to in-country public development banks, as you mentioned, and this can be able to strengthen the regional financing systems and make more financing available for sustainable development. If you look at last year, the IDB, it was able to invest, it was able to mobilize a record of around 3 billion USD, and about 70% of financing was mobilized by IDB, and in terms of the climate finance. So,
which is the way forward? Are we going to be focusing on MDBs as the most appropriate financing mechanism to rechannel SDRs, or are we going to be working with LSF, as Dr. Hopstone has been discussing with us? So both options seem to be very viable. Right now, the challenge is which one should we really go for? Should we just focus on African Development Bank and take it forward, or what next? But then now I probably want to invite Honorable John Frimpong from the Parliament of Ghana. It will be so interesting to hear what an actual policymaker has to say about their views on SDRs, and to what extent do we move with the MDBs or the LSF perspectives on this. So Honorable John Frimpong, if you're available, let us have your views.
In Ghana, I think we have serious economic problems, especially the financing of projects and activities. We currently can you hear me, please?